Welcome to the 7-Day Stock Market Bootcamp, Day 4, Stock Research. The 7-Day Stock Market Bootcamp is designed to introduce you to stocks and to build a foundation for investing in the stock market so that you become a savvy and confident investor. All of the materials published in this training is to be used for education and information purposes only without warranty of any kind. The materials and information in this training are not and should not be construed as an offer to buy and sell any securities named in these materials. Trading of securities may not be suitable for all investors. Both trading stocks and investing in the stock market may have large potential risk involved in which you can lose all of your money. You, the participant, and not Cassandra Cummings or StocksandStilettos.co, are solely responsible for any losses, financial or otherwise, as a result of trading or investing in securities. Although I may not be your financial advisor, I want to remind you that investments are not FDIC insured, not guaranteed by a bank, and you may lose your principal. Today we'll be talking about stock research and in particular stock valuation ratios. Ratios can be readily available through your smartphone or through a financial website and give you a quick analysis on the future growth prospects of a company to determine whether or not you should invest in that company. Let's look at a popular ratio amongst investors called the price-earnings ratio, or PE ratio for short. The PE ratio measures how much an investor is willing to pay for a company's earnings. The higher the PE ratio, the more investors are willing to pay for a dollar's worth of a company's earnings. It's calculated by taking the share price, dividing it by earnings per share to get the PE ratio. It's a great way to determine whether or not you should invest in a company. Let's take a look at one useful way to actually use the PE ratio, and that is to compare it to the PE ratio of another company in the same industry. Here we have Sprint and Verizon. Sprint's current PE ratio is 3.38. Verizon's current ratio is 6.57. Investors are willing to pay more for Verizon based on its future growth prospects. However, Sprint may be a better bargain because it's got a lower PE ratio. Two other PE ratios that you may come across in doing your research are called a trailing PE ratio and a forward PE ratio. Trailing PE ratios take a look at the last 4 quarters. Forward PE ratios are based on what analysts think the company will do in the upcoming 4 quarters. Trailing has a little bit more weight because those numbers have actually been performed by the company, whereas forward PE ratio is a little bit more optimistic. Your task for today is to take a look at your watch list and take at least one of those companies, find a competitor for it, and then find the PE ratios for both. Use the Yahoo Finance app to help you look for the PE ratio. Review those ratios and determine which one is the higher PE ratio and which one would you add to your portfolio. That's it for day 4. See you tomorrow. Want to get all 7 days of the Stock Market Bootcamp and more lessons? Take a look at the Stock Starter Kit. It's a great home study, self-paced program to give you a smart start in the stock market. Go to bit.ly/stock-starter-kit. Follow us on Facebook. Join our free Facebook group at bit.ly/Stocks and Stilettos. We're also on Instagram at Stocks and Stilettos. See you there.